So I post this thing on, the internet that my company, my customers had made a 12% gain in 2020 or an 18% gain in 2020. I had people coming at me from all directions telling me to take the post down because it couldn't possibly be true. I said, so it was, no mutual funds, no NASDAQ, no IPOs, no problem. Think about it. There wasn't any, right? So,
yeah. And we are back with the Money, the Mindset, and the Mentoring podcast. Today, we have a fellow Steve, Stephen Selengut, and he is of the incomecoach.net. And he wrote a book as well, which is an amazing book, actually, the Retirement Money Secrets book. And we really want to talk about investments and the do's and don'ts of investment. Now, you've had a couple years of experience in the business. Namely, you started in the industry 4 years after I was born. And so, that's quite a bit of time. I think that's 45 years, I guess, in the business. I think you've got enough of experience to be able to talk about a thing or two, celebrating your 79th birthday. So congratulations on that as well.
Thank you.
And really excited to unpack this. And, a lot of people are wondering, like, what do they do right now? It's an odd situation. It's an odd market, and they don't know what they're doing. Let's give a little bit of advice here from somebody who's seen a lot of the shifts that happen in the industry.
Well, we're actually in an interesting point in the markets right now, because the stock market is just below an all-time high. When you think about it, it's still really just maybe 4 or 5% above where it was over 2 years ago, but it's still at or near an all-time high. And at the same time, the bond market, which is the income side of the asset allocation, has just experienced the fastest run-up of 5 points in interest rates in history, just like it had just experienced the longest extended period of low interest rates from 2009, let's say, until late 2020, 21, where interest rates were practically zero, historically crazy. Since then,
before you get into that, I just want to hit something where you said, and I wanted to get this key point. You said it's on the income side of the investment. So what do you mean by that?
Oh, okay. Well, investments in general, there are 2 types of investments. There are equity investments, where you own a piece of the action. You own shares in a company. You're actually a shareholder. You own it, and you're not well treated because you own it necessarily, unless you go to the annual meetings, they'll take care of you. But in a sense of how much that Amazon or that Microsoft gives you of their profits, your profits, you're not very well treated. That's the equity side. But you are an owner. And just like if you were investing in your cousin's pizzeria and it went bust, you went bust with it. Zero. So that's the ownership element. The other type of investing is debt. When you're providing financing, in a sense, to the companies or the municipalities or the federal government by, buying their bonds and things like that. They're borrowing your money, and they have to pay. They have to pay you. They don't have a choice. They can't say no dividend this year like they can if they're a stock. They have to give you that interest. And when they get in trouble, you get paid before the shareholders. And in most cases, take, for example, Merrill Lynch, when it literally went under in the Great Recession, its shareholders got zero. Some of its bondholders got 20%, 30% on their investment in their bonds and things like that. So income investing, the fixed income side of the equation is part of your asset allocation. Typically, the advice is the older you get, the more you need in the income side and the less you need in the equity side, because that's where the most risk is, the most financial risk. And there's a big difference when I say financial risk versus what most people think of, which is market risk. market risk isn't really risk at all. It's a fact of life. The markets go up and the markets go down. Interest rates go up, interest rates go down. Economy is the same way, everything. So it doesn't matter a whole lot if a company like IBM goes down in price for a year or two. Typically, companies of that level don't go out of business. So its market risk isn't as important. It's not something to panic about, but everybody does. Financial risk, on the other hand, is the risk of losing your money. And that's what people don't concentrate on, and really what they should. So in somehow, and I have really never thought about it until recently, when I got involved in investing back when I was 25, I almost immediately recognized the importance of income in the investment process, or the act of investing. I always seemed to have this focus that I wasn't going to do anything unless I was getting paid for my money. You know, if I was going to buy a stock, I was only going to buy a stock that paid dividends, really for two reasons. For one, it showed a little respect. I'm an owner, you better pay me something, you know. And the other is because when that company has trouble, it's got to cut its dividends before it stops paying off its bondholders. When you see that happen, you know it's in trouble, because the publicity of a cut in dividend just can kill it. So if you see something of that nature, or even threatening, you get out of that stock quickly, particularly if you know.
So the canary in the coal mine is the cut of the dividends.
Exactly. So so when you get and you start buying in more speculative issues that aren't paying dividends, you don't have that one little extra indicator of the quality of the company. So when I was
over the 45 years ish of being in the industry, looking at stocks or equities, we'll say equities that pay dividends versus equities that don't pay dividends. You said, in other words, equities that pay dividends, they treat their owners better. And I think that's a great way of looking at things. But the idea is that do those stocks typically have a longer viability than the ones that don't pay dividends?
Not, yes and no. If they start paying dividends early in their existence, I would say yes. Okay. But when companies get started, IPOs is initial public offerings. When they get started, the requirements for being started in the various exchanges will vary, but most high-tech type companies, particularly when they're getting started, are operating in the red for years and years. Look at even Tesla, which is kind of a auto tech company. I mean, look how long it was before they ever turned a profit. If they've really turned a profit, I don't even know if they have. But that's what happens. And if they can hold on long enough until they actually become profitable, they can be very, very successful. It's still not likely they're going to pay significant dividends. Microsoft still pays less than 2%. On the other hand, you get some companies like utilities, which have always been the biggest of the dividend payers, because they've got a captive audience. I mean, you can't leave the utility company because there's nobody else providing. They have a monopoly in their area. So they were always a very high dividend payer because they knew they had the cash flow. They didn't have a problem. Oh, is this product going to work? Do I have to change my design? Do I have to do this, that, and the other to keep the consumer? Is there any competition? No. So it's that type of thing. It depends on where you are, what the industry is, how well you're doing, all that kind of stuff of whether you make that decision, I'm going to start paying a dividend. Because once you start, you really can't mess around with that. You either have to become one of those things like you've heard of dividend investing and dividend kings and dividend this and dividend that. These are ones that constantly raise their dividends. And people get all excited. Oh, wow, these guys raise their dividends every year. I said, yeah, but, they're paying you 2% now, and next year they're going to pay you 2.2%. That's great. They raised their dividend 10% or whatever. It's still nothing, when there are these and these, so many other things you can put your money in safely actually investing in exactly the same companies that will pay you more money than that.
So exactly the same company, but a different investment vehicle is what you're saying.
Different investment vehicle. For example, and I know you want to get this later, closed-end funds are a collection of, let's say, the collection of dividend stocks. And they collect all those dividends, but instead of paying the average of the dividends they receive, somehow they pay much more than that. And the way they pay much more than that is that by raising additional money from the shareholder IPO money from different sources, just like McDonald's, when it wants to build another outlet, it borrows money from a bank, builds a store, and starts doing business. These guys, the managers of these closed-end fund trust vehicles that I use almost exclusively now in my personal, yes, because that's all my practice is now, is my personal. But they go out and they borrow money and they just buy more investments. So they'll buy another 50% of the shares of all those dividend payers. So all of a sudden, their shareholders are getting that much more in dividends, and they can trade those securities and give them the capital gains. And they also emphasize that capital gain thing, which most people don't deal with at all. Most financial advice today doesn't talk about profit taking
on the capital gain side.
Yeah.
Now, on the day traders, and we think about those people, a lot of them, that's what they're particularly focused on, is it not? The capital gains? Yeah, but they're trying to turn it over in the same day. I mean, literally, they want to buy something in the morning and sell it sometime during the day. And if they don't make the money, some of them even sell it at a loss just because they don't want to hold it overnight. I'm not talking about day trading. Day trading and profit taking are two totally different mindsets, if you will. The day trading thing is you don't want to own or build capital or anything. You just want to find something that you can sell it for tomorrow afternoon. You're gonna buy it here, you're gonna sell it there to somebody else. Doesn't matter. I'm talking about building a base of capital with securities that are paying income, and when they go up in price, capitalizing or building a second stream of income by taking the profits and reinvesting in similar securities. I see.
So
now, when you look at the income side of things, you talk about dividends, but there's a couple other ones that you also handled before when we talked about the different other elements that you could drive investments and income out of your investments.
Yeah, the income can come from various sources. Like, let's say you have a closed-end fund again, where they buy all these big board, wonderful companies. Any company you want to name, the most popular ones like Microsoft or Amazon or anybody, they all on the market, you can trade things called covered calls, for example. Some of them pay dividends, but if you own the shares, you can sell covered calls on them. And I'm not recommending that any individual go out and sell a covered call. It's an option. Trades can be messy, but professionals who are doing it are only doing it when their shares are in, quote, in the money, where they have a profit position. Then they'll sell a call at that price. Okay? So if it gets called away from them, they have the profit. If it doesn't get called away from them, they have the premium that they received for selling the call. Yeah. So, and the dividend that they're receiving. Okay, so they've got dividends on this guy, they got the call premium, and then if it gets called away, they got the profit. So you got three separate types of income that they can share with their shareholders. And like I said, 95% of their income has to be provided to their shareholders, not reinvested. So
on the closed-end fund side.
Yeah. So on the downside of this type of investment, particularly in today's environment that focuses so much on market value instead of income, the downside is that if you're giving out 95% of your earnings to your shareholders, you don't have much left to grow your portfolio, do you? So these things do not tend to go up in price substantially. You're not going to see any $100 closed-end funds. You're going to see a lot of $12 and $15 closed-end funds that are paying you 9 or 10% right now, but they're not going to grow in market value. They're going to give you income that you can either spend or reinvest, and that's the niche that my business has always been in. I've always been dealing with people, maybe a little older or a little wealthier than the average guy just getting started. So they focused on the income from their portfolio, and I focused on finding ways to get them that income.
Nice.
And
you typically saw when you chase the income, because you talk about the categories of dividends, interest, and distribution, and you found through those categories that they were getting single-digit, double-digit returns. What was sort of the, like, over 40 years? I'm
40, you know, if you make 7.5% and reinvest it, you're going to double your money in 10 years. If you make 10%, if you make 10%, you're going to double it in 7.5 years.
Yeah.
So you have right now, for example, and these things, interest rate sensitivity is a concept that a lot of people aren't aware of. That if you own a bond, and even though it's a fixed, you loan somebody $10,000 and they're paying you 5% for the use of your money. If interest rates go up, the face value of that bond's going to go down, but it doesn't mean that they stop paying you the money. It still comes in. So a lot of people will look at their asset value and say, oh my God, the value of my bonds. My aunt did that with the value of her Ginnie Mae's. Ginnie Mae's, Government National Mortgage Association, guaranteed by the federal government. Mortgages they were paying her 9% plus a chunk of principal every month. And interest rates went up and up. This is back in the 80s or the early 90s, where interest rates went almost into double digits and stuff like that. And she was pulling her hair out. I was pulling mine out because she was pulling hers out, because the market value of her holdings kept going down. And I kept saying to her, Alice, it doesn't matter. Look at your check. It's the same every month, the same check. Don't worry about it. But it's going down. I'm losing. You're not losing anything. You know, it's the nature of income investments. The interest rates go up, price goes down. So she went to a banker, and he got her a nice little CD that would pay her like 7%, but the price would never go down. So when it came to paying her bills, what'd she have to do? She didn't have the income anymore. She had to sell the CDs at a loss, because they don't, if you don't hold it the whole time, you're not going to get the whole thing. So poor Alice lost a lot because of that.
That's a tough situation. I mean, it's a different way of looking at things, that the payment is the fixed amount and that the value of whatever that is the variable. I mean, it's like owning a multifamily residential.
There you go.
You know, when you own a multifamily, like, they can go up, they can go down in value, but the tenants is still paying the same. You know,
do you know how few people draw that parallel between rental properties and the way I invest in the stock market?
Really?
I had a great podcast 3 months ago with a guy on I forget the name of the podcast, unfortunately. That goes with my age. You forget things. But he really brought that out. He said, Steve, it's just like what I do with my apartments. I don't really care about the prices. I just make as long as I keep those apartments occupied, the people are going to keep paying me rents. I can invest in more property with the proceeds and blah, blah, blah. I said, yeah, the only difference is I don't have to have a plunger handy for when the problem goes. And, I don't have the other overheads that are with handling properties.
Well, the only other risk that you don't have. Yeah.
It's
the only risk that you definitely don't have is technical default. Is when you look at, that's probably one of the biggest challenges that people are running into today.
Right, because
that the value of the property is going down, such their loan to value is not in alignment with the banker policy. And so they have to make up the gap and come up with gap financing to cover that. And so that is a big challenge that happens in that space, where you would not have that in the space where you are.
And I was
because
thinking,
there's no lend involved.
right. I was thinking of another problem, and that's if you have a bad tenant and you have to get rid of them. And my dad used to have that problem occasionally. He was a real estate guy, and you can't get them out.
No,
It's hard to get people out in that situation. So that's another risk you have in the real estate area that you don't have if you're
well, I
buying.
think there's some feeling that landlords have a social responsibility for providing housing, whereas when you're doing what you're looking at doing, there's no tie to a social responsibility. It's just it's a contractual arrangement that's being honored.
Right.
And which is a very different thing. And I'm not saying that landlords do or don't. I'm just saying that's the big difference between the two.
Yeah, I agree. I agree with that totally.
Yeah, no, that's it. That's interesting. Now, when we look at other ones, we talked about the dividends, we talked about interest distribution. Let's talk about those two categories for.
Well, the interest, again, like we said with that illustration, is that all of these bonds are paying that interest semi-annually. Is the way interest is usually paid. When it's preferred stocks, it's quarterly. But they pay that regardless of what their prices are. So wherever you are in the interest rate expectation environment, the net asset value of your fund is going to be at a different level, but the interest is going to be the same.
Mm-hmm.
The market price will vary with the demand. For how many people recognize that treasury bills at a discount is a good thing and want to buy it? That'll determine how the price is impacted.
Yeah.
But the actual the income is stable. That's why they call them fixed income securities. And that's for the most part the type that the closed-end funds contain. And when you have a huge number of those things, and if you think about it, they have a liquidity that the individual securities themselves don't have. I don't know how many people actually invest in individual bonds these days, but just over the last 15, 20 years of my career, I can't remember the last time I saw a new person come in with a portfolio that contained individual bonds. I've been seeing a few of those in my coaching experience now, particularly with wealthy people who have a lot of individual municipal bonds, but I didn't see that much. So it's one of those things that not a lot of people don't understand, that now they can take those same fixed income securities that were such a hassle to deal with individually and trade them as if they were common stocks. Just as easy to go out and sell 100 shares of Exxon, you can sell a portfolio of municipal bonds without any markup, without having to get a quote from your broker or any of that stuff. You just say, sell it. And that's
because it's inside that housing.
Because it's in that shell.
That makes a lot of sense. That the shell is the thing that creates the liquidity.
The shell is the thing that creates the liquidity.
Interesting.
Yeah.
It's funny because a lot of people don't, you don't hear bonds being talked about a lot. I own a mortgage business. In the general public, in the mortgage business, we talk about bond yields all the time just because of the class of funds. Typically, we're looking at those to see as the bond yields, start to go up. We're like, okay, well, if the yields are going up, then we're going to see potentially bumps in the fixed price mortgages. If the bonds start to drop, then we're thinking, okay, there's some predictive analysis in some of those things.
Mm-hmm.
But it's other than that, when I'm talking to investors, I don't hear it's either they're talking real estate or they're talking about, crypto, or they're talking about, crypto.
Yeah, you saw my eyes roll?
I saw the eyes. but it was interesting. I'll talk about that one in a minute in relationship to the next topic we're talking about with risk. But we don't hear a lot about bonds.
Right.
Is it just because of the age category that I'm dealing with or the wealth category I might be talking to, or is it?
They're just not sexy enough. They don't go up and down in price. You can't trade them. You don't hear about them. They don't have any great heroes like Elon Musk again, or some of the leaders of some of these great companies. They don't have any of that going for them. There's nothing, and people they're not excited about putting their money, particularly younger people, about putting their money away and making 5%. They want to make a killing. They want to make that big hit, and they'll try and try and try and try. And I can't tell you how many IRAs that I've seen that people have been contributing to for 15 and 20 years, and they still haven't gotten to $15,000 yet. Because of all every year, I'm going to take this one, I'm going to invest in that guy, and that guy is going to, it goes to zero. So next year they try another one. Over the years, it just, people don't, I used to put, I think it wasn't long after I had gotten into the stock market that I started putting 30% of every profitable trade into the bond market. And I was buying individual bonds in those days. The first one I ever bought was Fort Pierce, Florida, 4% coupon bond. And I held it to maturity because I did. I don't know why. But the thing is that now
you outlasted the bond is why.
Yeah, right. Well, I started very young. I only had to be 55 to do that. So that's funny. But yeah, bonds, preferred stocks, things like that are not, even mortgages. I mean, I do a lot of, I do REITs and mortgages in this shell of a closed-end fund. Again, in that protects me a lot from that tax problem with REITs too, that way. But I don't do any individual bonds anymore, stuff like that.
Now, when the investments in the shell and you're looking at interest, does it mean that it's better protected also from a tax perspective? Because I know interest in Canada is handled a little bit different than the United States.
Yeah,
I don't know.
I can't speak to Canada, but United States, they get like a 1099 at the end every year, and they determine if the money they've given you is interest, you get it charged for taxes. If it's capital gains, it may be long-term or short-term. It may be return of capital. For example, if they have a mortgage and they got all the principal back on a mortgage and they didn't want to reinvest it and they wanted to build up their dividend, they might put it in there and increase your dividend, and you get it as a return of capital. So there's different things in that distribution.
Now, distribution. So we talked about dividends, interest, distribution. I just want to finally
dividends
cover
and interest are in the distribution.
Oh, they're in the distribution.
The distribution is made up of those different categories of income that the manager will develop.
Yeah. Right.
Okay.
Distribution is measured from like the shell kind of a thing.
Yep.
Yeah. Okay. So dividends and interest exist within the shell, and that comes out through distribution.
And it's usually a monthly distribution. On the income side, most of the closed-end funds pay monthly.
Yeah.
Which is so you don't have to worry. Most of them have ladders inside so that they laddered maturities inside, so they can pay it monthly.
Yeah. With
their bonds. So the individual, in most cases, the retiree doesn't have to worry about stuff like that. He gets enough a month. Of course, some are quarterly, and that screws it up a little bit.
Yeah. Now, with the next topic, talking a little bit about risk, that's probably one of the hottest words to be using right now. We talked about bonds, maybe not the hottest, sexiest word to use, but risk certainly is.
Yeah.
Because you've got every economist over here saying, the world is coming, the end is nigh. And then you have the economists over here saying we're at the bottom and we're about to boom and all this other things. I think they draw straws every month to figure out what they're going to talk about. So when you're looking at analyzing risk, what are sort of the mechanisms that you use? Because when you look at your band over 40 years, 45 years, you've seen it all.
Right. And I've developed what I call the 4 pillars of risk minimization. And the risk that I'm talking about is the financial risk, the actual risk of loss, not the risk of market value, because there's really nothing you can do about that other than putting your money in the bank in a savings account. It's not an investment if there's no risk.
So wouldn't you have risk when you put in the savings account, because every year when the government, prints more money, it's worth less?
Well, inflation, I guess, is a risk, but you don't have a risk of financial loss of, them taking the whole chunk at once from you because it went out of business.
So inflation is just death by 1,000 paper cuts.
Yeah, And that's why it's so important to grow your income. That the only way you can beat inflation is by making your income grow more than the rate of inflation.
Yeah. Yeah.
Because inflation is a measure of the buying power of your money. It's not market. A change in market value doesn't increase the buying power of your money. No. It just increases your ego. You know, it's the brand of cigar you feel you can afford to buy. You know, that's about the thing. The only thing you can spend is money.
Yeah.
And if you have more income, you don't have to take that money out of what it's invested in.
That makes so much sense.
So, but the question was back to risk. So these
let's go back to the four
pillars of minimizing financial risk. Okay. A, come up with a way to determine the quality of everything you buy. Just like in real estate, you're not going to buy this particular place because of its location, and you're going to be able, and you'll pay more for that particular place because of its location. Again, the risk, how many years it's been in business, does it pay a dividend? What's its price range? Is there really demand for it? Things like that. You know, PE ratio, if it's an individual stock, is very important, right? Mm-hmm. In a closed-end fund, I like to look at, well, I think volatility is a good thing, not a bad thing. That's another oddity of my methodology. But still, the quality, you have to know the quality of the thing you're investing. The higher the quality, the safer it is, the less likely you're going to have defaults or going out of business. Diversification is the second pillar, okay? And that means you want to spread out. You want to spread out different managers, different sectors, different durations if you're looking at long-term or short-term bonds, different countries. You want to go, it is really a global economy, no matter how many politicians try to change that. It is. Yep. And hopefully it'll always be that way. You know, so diversification in various types is important. The third one we've touched upon, it's got to generate income. If it doesn't generate income, it really shouldn't be in your portfolio. Okay, especially when income is something you need, you know. Yeah.
So we look at, first of all, quality, and the second one we say diversification, and the third one we look at income. That it actually has to produce income, not just go up and down and bounce around on that beautiful little chart everybody loves looking at. Right, it's got to produce some income, and that's where you're getting that real value coming out of it. What would be the fourth one?
The fourth one is the one that people ignore most, and that's profit taking.
Talk to me about that.
Profit taking is like getting to March 2020 or getting to January 2020 and having a portfolio that's worth $100,000 with lots of profits that you're really proud of how high your Microsoft is and your Amazon and so on. And then in March, when COVID takes the stock market and turns it upside down, and you're looking at it and you say, oh my God, all those stocks just went down 30%. The market's down 30%. What am I going to do? A lot of people sold everything. They do that in every correction. 87 is the funniest story of them all, but they always do that. On the other hand, if you had started taking your profits in January, in February, by the time March came around, you'd have all that money figuratively in the bank that you could now take advantage of the prices that went down and start buying those companies again. So profit taking cuts the risk of that paper loss that many, many people turn into an actual financial loss because they panic. I always used to say that unrealized profits most often go to the tax report on the Schedule D. That's the one that has the losses on it. Yeah. I think it's still the Schedule D, right? I don't do my own taxes anymore. So, but that's those four things. And it's like a stool that has four legs. If you don't do one of them, the stool's going to fall over.
The stool's going to fall. Well, because I think that fourth one is when panic mode comes in, you're not looking at it as an opportunity. When the market does that shift in value of stocks,
Right.
You're going to look at that and panic and realize that that's not realize it's an opportunity, a threat, and operate in the way that.
Right. Again, that's similar to real estate, right?
Mm-hmm,
When you guys see lower prices, you start rubbing your hands together and say, okay, we're going to go buy something.
Yeah. The only thing that always factors in real estate, though, especially now, is just it's not about the asset itself or anything around that. It's around how much is the government sort of mucking with the policy around it, and that sort of changes a lot of opinion around the investing. And we can see this in real estate where people are saying, look, I'm going to invest in Sunbelt states because they're landlord friendly. I'm going to invest in this area because it's landlord friendly. And how much of that do you see where the government sticks their hands into your space and mucks things around to change people when they look at those four pillars?
Have you ever heard of the SEC? True story. Back to 2020, and we can go further.
Yeah.
In 2020, the market was going crazy, and I had, I have this idea where I'm going to take profits at around the 5% level.
Mm-hmm.
Okay. So we were going along 5% level, and then we got to the 6%. And so I had so many that I was taking that the guy I run my business through, the broker, was saying that the compliance department, because I'd also be buying with all that money, I'd be also buying. The compliance department was beating him up because I was trading too much. Now I've got $100 million. I've got 150 clients, all with separate accounts, like 300 different accounts, and I'm working in every one of them, taking profits and buying. And we're having too many transactions. We can't be taking these profits. We can't do. I said, you can. You're out of your mind. This is like you're walking down the street and there's money lying in the sidewalk.
You're not allowed to pick it up.
You can't pick it up. You out of your mind? So they made me go to 7%. I couldn't take any, I had to have at least 7% of profit. So I was BMC, BMC is bitching, moaning, complaining, the whole, so I was infuriated, but that's what I had to do. So I was doing that. And then finally it started getting worse and worse and worse. So at the end, when it went down all at once, and all of a sudden there wasn't anything more at 5% or 4% or 3% even. That was all negative now, the same stuff. I said to Ken, I want you to get to your compliance department and tell them that they owe our clients about $450,000, and I want it now so that I can take advantage of these lower prices.
Yes.
So you go tell him that. He said, he laughed at me. Of course he did. But that's the way it was. That's the way it is. And that's one of the rules, Diversification, they don't usually bother you, but they don't set any percentage limit. I feel uncomfortable if I had more than 5% of a portfolio invested in any one security. I think I read that in a textbook when I was in college, that was right, proper diversification. For income, I've already said I'm not going to buy anything that doesn't have income. Well, Steve doesn't own this, and this. And Ken will say to him, well, Steve doesn't buy anything that doesn't pay income, because income is what our clients need to feed their families, you see.
Yeah.
And they didn't understand that either, so. And our judge of quality isn't what, what's his name on TV says is a good buy. It's which ones have been in business all this time, are profitable, blah, blah, blah. So they're on us all the time. I used to publish some things, and I'd speak about performance numbers in the sense of how much income we made, or in the dot-com bubble, when everybody was saying what a lousy market it was. It wasn't a lousy market if you were buying high-quality New York Stock Exchange companies. It wasn't a bull market. I mean, it wasn't a bear market when the dot-com bubble occurred because those things had never gone up because everybody was flying to the NASDAQ. So our stuff, the stuff we own, because NASDAQ companies at that time didn't pay any dividends at all. I didn't own any of that stuff. Those good quality companies now all of a sudden started to come back. So I post this thing on, the internet that my company, my customers had made a 12% gain in 2020 or an 18% gain in 2020. I had people coming at me from all directions telling me to take the post down because it couldn't possibly be true. I said, so it was, no mutual funds, no NASDAQ, no IPOs, no problem. Think about it. There wasn't any, right? So,
yeah.
So you could ask my wife. We got audited by the SEC, and they came in and they were looking at this spreadsheet. I had this spreadsheet that I had put on there without the names, and I showed the bottom line. They came in to investigate this, and they reprimanded me when they left because I had understated the gains.
Well, they had to do something.
Yeah, right. So they didn't find me, but they reprimanded me.
I always do that when I do my taxes. I always leave a couple nuggets in of tax savings.
I agree.
When I get audited, I always let them find those nuggets. I'm like, man, you just saved me some more money. Thank you.
Yeah, I always make sure I'm paying it. I tell my accountant, don't save me too much money.
Yeah. Just enough. Just enough.
Yeah.
Yeah, that's managing risk right there.
Right. So so those are the risk minimizers. But another two things that I think people really need to do to get their mind around the idea of how to actually make some money in the stock market and buying and selling is to understand that there is a cycle, a market cycle, and an interest rate cycle. And it's not easy to understand which way it's going to go. That's impossible. But to know pretty much where you are, when we started first talking, I said we're at a down cycle for the interest rate market and an up cycle for the stock market, which is an interesting pace to be. It's nice. It's very nice. So that thing, and the other thing is the mindset of what's really important long term. Is it the growth in the market value or the growth in the income that should go along with it? Because eventually you're going to need to pay that income. I started my business in 79. I was 34. When I was 25 and I started investing, it was mostly in the stock market. When I started my business, I was making 5 times in literal income from those investments in dividends and capital gains than I was making at my job in New York City.
Wow.
And I said goodbye. I'm gonna do this I'm gonna somehow get to do this for other people. And I
think you time studied your income based on your time spent, really, and that's a just judicious good management of the one asset we don't have in completion, that we have no idea when it's going to run out, and which is time.
Yeah. I'm hoping for a little more.
I'm thinking you gave me a little breakdown on the DNA. I think you're not. I think you got a good bunch of years left. So we're good.
Yeah,
we're good on that one. So right now, if you said to somebody from a perspective of trying to figure out, it's 2014 May, and you were saying we could be considering a down cycle on the interest rate, and potentially you said an up cycle on the market. Is it a stay as you go, or is it a put more in, or is it a holding pattern? What are we looking at?
Did you mean May 24, right?
Yeah, May 2024. Yeah.
Okay. Yeah. Right now we have distinctly different places in the cycles. Mm-hmm. The stock market is at or near an all-time high, but not at a huge high in respect to where it was 2 years ago. Okay. Yep. The bond market is at a low because of the rapid increase we just had in interest rates.
Yeah.
So it's So even if that were to drop off a little bit, it's not going to get as high as it was 5 years ago when interest rates were zero and had been for some time. Okay. So you got this distinction that interest sensitive securities, bonds, closed-end funds that focus on income are at a low price, while stocks are pretty much at a high price. So let's say you're in a position where your financial planner says you've got too much in the stock market, you're 65 years old, and you shouldn't be 80% in the stock market. Well, now's the time, fella, to move that money, take your profits and move it into the fixed income market because it's down. So it's an interesting place in time.
Because you're buying at a discount right now when you're looking at it.
When you buy the income stocks, you're getting 10% while you're taking your profits up here.
Yeah.
Most people get talked out of that because they have to pay taxes. And
it's a taxable event to do that.
Oh yeah, it sure is.
Yeah.
I mean, not in your IRAs and your rollovers and your Roths. I like to think of a Roth. I think of Roth as a wonderful, wonderful vehicle because you can trade and you can develop cash flow. You can develop a cash flow with generally taxable securities in a tax-free environment. So here I am talking to some big investors who have large portfolios in their personal realm, and I'm talking to them about, you can get 5% tax-free in closed-end funds right now, which is very attractive to that level of people. But
the tax-free 5%. You put those two things together. That's
for the taxable account. But when you can make a similar tax-free situation in a Roth account, instead of going for the, safety or whatever in a Roth account, that's where you can be aggressive and have an equity, a 50% equity portfolio. And if you're an older person, if it's in an equity environment that's paying 8 and 9%, like ETFs, CEFs right now are doing, because all interest rate sensitive securities go together. So even the ones that are invested in the stock market are still paying a much higher yield than they would if interest rates were also down.
Now, closed-end funds, you use this word like 300, 400, 500 times in our discussion here.
Yeah, I know.
Yeah, and let's talk a little bit about that, because I think it's something that people need to understand, because it's not something that, again, just like bond yields, people aren't going to be talking about bonds other than myself. Like I follow bond yields all the time, but the idea is, what are they, and why aren't more people doing them?
They actually are a very, very old vehicle. They were developed, some people say, in Amsterdam in the 1800s. We say they were developed here in the 1800s also, but they were actually developed before mutual funds were. And these things are trusts where you own a manager or a company like BlackRock or Nuveen will own a whole portfolio of securities, and they'll put it under a shell or, under the dome, so to speak, as you put it, in a bucket all by itself. And that's the thing that they manage. And the trust is owned by shareholders who buy shares of the trust, just like common stock. And the managers must pay out to the shareholders 95% of its realized net income every year. So these are not growth vehicles in the sense that we want to watch their market value go up and up and up, because it just ain't going to happen if you got to give out to your shareholders all that money. Amazon wouldn't be where it is today if it had to give out 95% of its profits since it existed.
Yeah, not even charities do that.
However, a lot more people would be a lot more wealthy than they are now if Amazon had done that. So the closed-end fund is a different type of organism. It's not a stock market organism that's designed to grow your market value. It's designed to grow your income because that's their purpose in life. So they're going to take profits when they have them. They're not going to pass them up and say, we want to grow the market value. They're going to take those profits and they're going to pay them out to the shareholders, and they're going to continually do that. They own pretty much the same securities you'll see in ETFs and in mutual funds. The difference is the one we just talked about, the purpose, and the other difference is one of the methods they use. They've got a fixed number of shareholders, just like a common stock would, and equity financing is one of the way the stocks work, but there's also a debt to equity ratio when you talk about a common stock. Very important. There are very few successful companies out there that don't have large amounts of debt outstanding. And that's, the use of other people's money to put up the infrastructure you need to generate your wealth and so on. And if you can make more with that money than you're paying in interest, it's a no-brainer, basically, particularly when interest rates are down at 0% level. That's what these managers can do in a closed-end fund environment, in this trust environment, because the ownership is separate from the securities, and it's the ownership interest that's borrowing the money. You're not margin investing on the securities you own. Like if I were to do the same type of borrowing against my stock portfolio or against my bond portfolio, that would be very dangerous. I mean, I managed money for people for many, many years, and no one ever, if they were going to do business with me, was going to have a margin account, because it just doesn't make sense. It's crazy because it's a variable rate.
Yeah.
Okay.
So when you talk about margin on the stocks, that's where, like, I remember I played this stock market game in high school, where you could accelerate. It was the kerosene you're going to put on your investment, and you're going to set it up on margin, and because you want to win the competition, so you're going to throw everything on margin and throw everything to the wind and see what happens. And you're either going to crash and burn, or you're going to look like a hero.
Exactly.
And it really was just like roulette. You're going to put everything on 36 or 24 and then borrow from Louis and put more money.
Exactly.
That's what happens. Yeah.
Exactly. So, so you don't just like you don't want to get your credit card balances to be too high these days. When we have a situation where these guys can charge you over 20% for money, that wasn't the way when I was young. The interest rates on credit cards were not like that. But
so when you talk about the borrowing the money, we're not talking like that. We're not talking margin. We're talking in a different way. Right.
We're talking the same way Exxon borrows money to go put out a platform in the ocean.
Yeah.
They do it. And they also issue fixed rate preferred stock as well. In fact, some people, a lot of people, I've actually seen some lists lately of the preferred stocks on closed-end funds as being a good type of preferred stock to get involved in.
And let's talk about the different classification of stock, because I think people don't realize the difference of preferred and all the different categories. Okay. Yeah.
Okay. Common stock is what you own when you own a share of a company.
Yeah.
And that's an ownership interest. You own a piece of the action, period. You also are responsible for all the losses. So, it goes both ways. A preferred stock is more of a debt security. It's preferred, and the reason it's called preferred is because you get paid back in the case of an emergency before the common stock shareholders, but after the debt holders. So it's in between. That's why it's called a preferred stock. That's the only. It's because you get preferential treatment in the case of a bankruptcy. That's why it's a preferred stock. It generally pays the same type of quarterly dividend. It's typically a fixed rate that it's issued at. It can be called by the company at their discretion. You have to be told about that, and you should make sure your broker knows whether it is or is not. Of course, clearly, if it's a high rate, they'll call it when rates go down and replace it with something else. It can also be convertible. It can be convertible into common stock. And there are occasions where, let's say you own preferred stock in something like, what was that stock on the NASDAQ that had that big run up?
The GameStop or whatever it was?
NVIDIA?
Oh, NVIDIA. Oh, that's the one. Yeah.
If you had preferred stock on that you had paid when the stock was, worth X dollars, $100, $200 a share less, you could convert that into common stock and sell it.
Wow.
So, so there's those types of things. So there's also debt securities that you convert to common stock too. And closed-end funds have all of these different types of securities. So
now, why would somebody manage a closed fund versus any of the other sort of housings that we have that have a lot more flexibility?
It's a product that is an income. It's an income emphasis product that's really needed, and there are literally billion. I don't know if it's a trillion, but it's a multi-billion dollar. At least three-figure billions that are invested in these things, and the biggest companies in the world. BlackRock's the biggest one. They're the biggest investment manager in the world, I think. And they
pretty much.
And they almost have a monopoly on the municipal closed-end funds. They're the biggest player in that market. Them and Nuveen, and then you have Nuveen. You have there are you've heard of Aberdeen. You've heard of Liberty, BlackRock, John Hancock, Nuveen, Calamos, Cornerstone, Eaton Vance, First Trust. There's just in my universes of these things, there are over 50 different management companies
of these closed-end funds
that manage closed-end funds. And it's just like the managers you see when you look at a mutual fund. You'll see the name of the guy that's running the fund and his assistant. It's the same thing with these. When you look them up, there's a different manager that's responsible for all this stuff.
But they're not caring so much about the value volatility of they're more looking at the income. And then just going through the distribution. Right.
They're growing the income of it. That's their method of operation. That's what they're there for. They're not there to build market value.
Yeah, that seems like it's always the way. I think real estate, when we go back to the real estate, where it sort of went astray, is being so highly focused on capital appreciation, not enough focused on cash flows and those payouts. And I always say, when you're looking at evaluating real estate, you have to look at it as if it's a stock. And the up and down value of the property, that's that sort of equity element. And that's, you should think of that as like a bonus, not as your payment. But your payment's coming out of that cash flow. That's your dividend.
Right.
And that's where I put those two together. And you say, well, if I have $1 million, am I going to put it into real estate or into the stock market? Well, if I can normalize the verbiage so that we're using the same language between the two, it makes it very easy to make the decision between the two. Yeah.
Yeah. And I'd say there are probably 15 or 20 different closed-end funds that have a real estate as their investment vehicle.
Oh, really?
Oh, yeah. Really. The one that comes to mind, I don't give symbols, but there's Royce Cohen Steers. Cohen Steers is a big one and does REITs and income realty.
I just ran into one who does
there's a fund. Nuveen Real Estate Income.
Nuveen, yeah.
They all do.
Interesting. I just ran into one that has a fund where they raise capital for single family homes, not just multifamily. And so the REIT specifically focused on single family.
Yeah. REITs are great. I used to use them a lot individually, but then sometimes you get this the problem with the tax reporting at the end of the year. And was that REITs or is that? No, that was master limited partnerships.
Oh, okay.
Yeah. REITs were good. They're a little bit, they're not as volatile as most securities, but they do have their times with the real estate market that some of them go down a lot. I like the comfort of the diversified portfolio. I don't, if I had a big enough portfolio that I could buy 20 different highly rated REITs, I could feel comfortable that, it would be too much in one sector, of course, for me.
Yeah.
But I like the idea of having, just a piece of the action. I think what I've done with diversification is something very different, I think, from what most people get to the point where they think of diversification as a risk minimizer, as a defense mechanism. Okay? But think about if you have a diversified portfolio that has something from every sector, every country, every economy, then you have an offensive weapon. If you're interested in taking profits.
Well, that's a macroeconomic way of looking at it, I think, when you look at the micro, because you're actually making money across. It's the perfect hedge, is it not?
Oh, I think so. Because I've got no matter what sector is going up, I'm going to be able to take profits of it, and my mindset is to take those profits, not just to watch the value go up. And while the value is going down, I look at that out of my other eye, and I get, of course, headaches doing that. And I'm looking at the ones going down, so I know that I have something to put that money that I just made in the profits into this one that's going down, because that sector is not going to stay down forever either.
So you're always chasing the bottom to raise up and liquidating at the top. And because you're covering all sectors, the one thing that you can always bank on,
higher and lower.
Yeah.
You don't know tops and bottoms.
Well, higher. Fair enough. Fair enough. That's interesting. And I mean, the one thing you can always bet on is that governments are going to make maybe not the right decision. And they're always going to affect those things, which means the currency in which we're baselining is always going to be devaluating, which is the inflation. And if you're crossing all of those sectors, you're like your maximum hedge. And the only thing I would say is you're diversifying in the product, but you're actually specializing in the application of diversifying. So you're actually not diversified through your specialization in the tactics in which you're using. So, because a lot of people look at diversification as a negative when you bring up the word, they're like, don't diversify, focus on the one thing that you know, make the one thing the one thing. Your one thing is your diversification specialty, which makes it actually a one thing.
Okay.
Yeah.
Okay. I can't say that I 100% followed that, but I don't think it's a bad thing.
Well, I think you have 4 pillars. So actually you have 4 things.
Yeah, you're right.
And so you're not actually diversified. You're saying, look, if it's not in these 4 pillars, I don't care.
It's not in these 4 pillars, but these 4 pillars apply to all things.
Yeah, but it's not to all things, because you said right away from the very beginning, if there's no income, I'm not going to pay attention.
That's right.
So therefore you've now
one of my pillars is income. Yeah, I'm specializing in income.
Yeah, exactly. And then quality, you said if it's not quality, I'm cutting down. So you're specializing.
Okay, that's true.
Yeah. So through your diversity, you're actually specializing, and then diversification after that specialization occurred.
All right. Okay.
Yeah. Which I think then you actually win on all fronts.
So far, I've been lucky.
and that we're going to finish the episode with so far I've been lucky.
There you go. Okay.
So people to reach out for you, because we've clearly covered everything and anything with investments. The best way for them to reach out is theincomecoach.net. That is obviously the first way for them to reach you. And obviously to grab the book, Retirement Money Secrets, and check that one out. It's a good read. And man, it's been an absolute, there we go, right there.
You want to see what it looks like?
Yeah, man.
There we
go. Beautiful.
Retirement Money Secrets.
That looks great. So I would say reach out to Stephen. He's a great fellow. It's been a great chat with you, and you got a great name. And hopefully I can back it up, and keep the legacy going in the name Steve. So
great.
It's been definitely a pleasure. Thank you very much.
Okay. Thank you. Enjoyed it very much.
This is the money. This is the mindset. This is the mentoring platform. We will see you on the next one.